Brought to you by Prescient Investment Management. Informed by science. Guided by insight. Prescient Investment Management is an authorized FSP.
Welcome to another really special episode of Honest Money, where I'm really thrilled to have the finance ghost with us again. He's certainly one of our favorites inside Honest Money, both as a guest, but also as a writer, podcast host, and all around interesting, quirky guy around money. So, finance ghost, thanks so much for joining us.
Thanks, Warren. It's always lovely to do these with you. I know some people in the market think you are the finance ghost, which I'm personally very flattered by, but you're good, but you're not so good that you can do two different voices on this podcast. So for those listening to this, Warren is actually not the finance ghost. There are really two different people on this podcast.
Yeah, we had a funny incident a little while ago where a finance ghost was on a kind of a group call, coincidentally with my wife, and someone asked my wife if the finance ghost was me, and I was just happened to be the driver of the day. So my wife found that hysterical, I must say.
It was very funny from my side too on that phone call. It was brilliant. It was an unlock the stock call, which is a wonderful platform that Vanessa is involved in. It was quite funny. But no, I am not Warren Ingram, in case anyone's wondering.
So I just want to touch on that. So you do a series called Unlock the Stock, which focuses on shares on the JSE and especially getting the platform for investors to listen to most often the CEO of a company talking about their business. And I think it's it is really a great initiative to make investing more accessible for ordinary South Africans, where it's very hard often to actually get accessible information from a CEO. Listening to a company results presentation is mystifying even for the analysts. So kind of obliging the company CEOs to explain their businesses and the like in an approachable way, I think is a great initiative. So well done on that. But you also host Magic Markets, and I think important for people that enjoy investing in shares. It's one of the things. I know we talk a lot on Honest Money about index investing and active investing and unit trusts as well. But there are a portion of investors in South Africa and around the world that enjoy owning companies, and I think so this is a free endorsement for Magic Markets. I think really worthwhile. If you enjoy individual shares, have a look. I like their premium platform because that gives you a lot more information. So I just think you don't have to say anything finance ghost about that, but just from my side, it's not often that I'll talk about other people's podcasts, but this is one that I think I'm very happy to go on.
Thanks, Warren. Appreciate it.
So let's get into today. We've got a few things. One, for those of you that don't know, Finance Ghost's loves in life, definitely his family, but I think almost a very close second will be money, and then very closely behind that is cars. And so he is a car fanatic. And so today we want to talk about cars in a couple of ways. One, I think we need to just explain why neither of us like this concept of balloon payments, and I'm going to let a finance ghost start that. But then secondly, which is maybe much more fun, is how you can own great cars cheaply. And I think that this is both of us are. I'm maybe not as fanatical about cars as Finance Ghost, but certainly we both like cars. We just don't like to pay ridiculous amounts of money to own or drive them. And so I think it's nice just to talk about that as the follow-up. But to start, I'd love to just kick off on why you love balloon payments. Not at all.
Yeah, I really don't. So look, balloon payments exist to help people afford cars they can't afford. So that first afford is very much in inverted commas. So what balloon payments do is they reduce your monthly payment. And all it's doing is saying, by the time you are done, again in inverted commas, paying for this car, you will actually still owe us a whole lot of money. Sometimes it's 40% of the capital value of the car, because all you've done is you've paid off a very small amount of capital over the period of ownership. You've basically rented this car. And at the end of that period, you're either going to give it back and hope that covers the balloon payments, and sometimes the manufacturers will give you a guarantee that it will. Other times they don't, and then you either need to refinance that balloon or take a knock or who knows what. And there are a whole lot of issues with balloon payments. So one of them, for example, is because you are amortizing the debt so slowly, and that means paying down the capital value. Often you are actually in a situation where the car is depreciating faster than the debt is coming down, especially because balloon payments are often on a new car, and new cars get murdered in their first year from a value perspective. So if you run into trouble a year later or 2 years later, something changes in your life, maybe a baby comes along, or you need to move house, or you want to immigrate, or whatever you want to do that you hadn't planned, you're now sitting with a car that is depreciated a whole lot more than you've already paid off, and you are now effectively underwater. If we just look at that car, you're actually insolvent. You've got to chip in now to get out of it. I mean, that's just a crazy situation to get yourself into, right? It just doesn't make sense. And this is why my view is that, a balloon payment is there to help you buy a car you actually can't afford. And that is extremely dangerous.
Yeah, I mean, I can't agree more. And, it's one of those things where the numbers have never added up for me. I've never managed to make it work. So, the car dealerships especially love to sell a product. That's what they're extremely good at, and well done to them. But when they add the finance element to it, that's the part that really bothers me, because all they're doing is trying to show you on a month-to-month basis how you can get your repayment down as low as possible. But when you do the calculation for yourself, and you really need to do it for yourself, and you work out, the cost implications for you, as Finance Guy says, I just think it doesn't work. And part of it is because you're paying interest on the capital that you have to pay in at the end. So it's almost like they're lending you that money for the balloon payment. You're paying interest the whole way through. It's just that you don't see it like that. And so, if you want, there are very few people in the world that can start life, in their first career, or maybe their first job or their second job, and actually buy a car cash. It doesn't matter, what the car is. And so I understand that, financing a car is a necessity for a lot of people on day one. But then, please, pay the biggest deposit you can. And I think at the very least around a third of the value of what you're going to do. That's a great way to get the monthly repayments down. It's the biggest deposit you can, because you're financing yourself. You're not paying any interest on that deposit. And then you drive that car for as long as you possibly can, so that you can save up money to buy your next car with cash and the trade-in of the car. To me, way better alternative than a balloon payment. It's just, that's not affordable.
For people who follow the results of listed companies in this space, I'll use We Buy Cars as an example, which is owned by Transaction Capital. And there's nothing wrong with We Buy Cars, but a big part of their strategy is now to push what they call the F&I income. So that's finance and insurance, because that's where the dealers make their money. They don't make big money on selling you the car. They make what is called their second gross, which is on selling you the financial products that go around it. And the way this happens in the dealership is, okay, you want the new BMW 320i. That's cool. Here's the list of options. And if you don't take these options, you're really going to hurt your resale value. You're really going to be able to sell a 320i that doesn't have a multifunction steering wheel. I mean, I don't know if that's standard these days, but there was a time where on these cars, you get nothing in the base price. You have to spec everything. And they're right, by the way, you will have a horrible resale experience if you don't at least have a decent spec car. But the problem is, by the time you're done, you've added 100,000 Rand to the list price. And then they go, well, look, we can make this work for you with your monthly budget, but you're going to have to take a balloon payment. But don't worry, because in those years to come, by then, don't worry about it. You'll have made so much money, you'll be able to pay it off, or you can just refinance it, or we'll guarantee the car. And by then you are so deep in the sales process, all you want are your new wheels. And yes, you do want sat nav. And actually that sunroof seems like a great idea. And by the time you walk out, you're 100K more down the tubes than you ever were before. If you were paying cash for that car, you would never, ever allow that to happen to yourself. Ever. If you were buying it out of your access bond, which is my personal favorite, i.e. that's what I do, it's real money. You are doing an EFT for that car. You're not signing a piece of paper with a Westbank letterhead on it and it's just, next month it's $5,000 and that's fine. Then you understand where these costs actually come from. I mean, even the fee every time you take out a new car finance package is what, 3,000-4,000 Rand, I think. I don't know. I've never actually, I've done it once. No, I've never done it, to be honest. And, that just tells you every time you change car, you're already throwing away 3-4 grand, just like that on the first go. And it just gets worse from there, So cash is kind of the way you want to go for as long as you can. I mean, the way I did it, I was very lucky. As a teenager, I got my first car, it was a Corsa Light. I had a bursary for high school, and my folks said, look, we managed to save so much on your high school fees. We can get you a first car. Here it is. And I kind of just worked up from there. And then, the only way I would upgrade is if I could sell that car, put in more cash, and get something else. It's kind of been that way the whole way through. I've never actually formally financed a car in my life.
Yeah, I can't say the same because I made all the mistakes where I'm trying to help people not make, and that I remember earning my first salary and then going to the BMW dealership. I'll never forget in Claremont in Cape Town, and saying what can I afford, and then trusting the BMW dealership's finance person to help me make that financial calculation, which was an absolute disaster. But that was a good lifelong lesson for me that I hope our listeners don't have to repeat. And maybe two other little quick tips from my side on this would be, do these decisions as a team. In other words, if you're married and your wife is not a car person, help her help you to make the car buying decisions. Because I can tell you, I'm married to the spreadsheet queen, and we don't spend a lot of money on cars because she's completely unemotive about them. And her question will be, do you really need all of those buttons on this, or whatever it is that she's so unimpressed by cars and my affinity for them.
So Oren, sorry, I have to just say on that. So Mrs. Ghost is the polar opposite. She's the devil on my shoulder. She's like, you work too hard, have fun, spend your money, enjoy it. Why don't you have this Porsche yet? So it's so funny. Like every couple is different. Every single couple is brilliant.
So then, if you are married to another car fanatic, get someone who is not a car fanatic but has your interest at heart, and help them to help you make that decision. Because I think. I mean, it is an emotive thing, especially for some reason. Mostly men. I don't know why, but we're a sucker for cars. And as you say, it's not just men, but it's tricky for me. And then I just want to kind of jump onto. This, as you said before we started the recording, this is not about car bashing. This is about how to afford cars, and so let's talk about. This is an experience I don't have. How to drive great, or own, I should say, great cars cheaply.
So it all comes down to being willing to drive something older. Like that's the first step. So if you are going to insist on driving something that is literally brand new out the box, there is a handful, and I mean a handful of cars that hold their value for the first couple of years. Very much special editions, huge initial purchase price. If you've got the money for those sort of cars, you're not worried about what it's worth in a year's time. Let's just start there. So for everybody else, you can either go and buy, a brand new 3 Series, 800,000 Rand, or you can go and buy a sort of late 2000s Porsche 911 for the same money. Now, the 911 is going to hold its value. I can guarantee it. In fact, it's going to probably go slightly up in value. They are done depreciating. Whereas that 3 Series has got a very long and ugly depreciation curve ahead of it. But the problem is you can't go and finance that Porsche. In fact, I don't think you can finance it at all. You certainly can't finance it with a big balloon payment. So the problem is it perpetuates the cycle of debt. If you keep buying new and flashy things, you're going to keep needing to do it with debt, and you're going to keep losing value every time. I mean, you work out, if you lose 300,000 Rand on a car, just take your average tax rate and gross that up and work out what you need to earn to make up for the 300K that you just burnt on that car. And that will make you think very long and hard about how much of a smart idea that is. So for example, I had a Honda S2000, amazing thing. It's a cult car for all the right reasons. It's magnificent. I mean, I'm a huge petrol head. And I got back the full purchase price plus everything I spent on maintenance 2 years later, because I bought it at a time where I could see they were going up. Another wonderful example is an E46 M3. So that's sort of, what is it now, 2-3 generations ago, M3. And they've gone up in value. So you can go and be driving a really good car with infinitely more power than any of the new sort of 3 Series is at 800K. And that sort of cool car status for anyone who knows anything about cars, they'll look at that and understand what they're looking at. And you're paying a few $100,000 for it. It's cheaper to insure typically than a brand new car. You're paying way less in interest because your entry price is far lower. Like, people forget about the total cost of ownership. The total cost of ownership is your interest, your insurance, yes, your fuel is in there as well, but it's your depreciation is the biggest thing. So it's a very different spreadsheet for a 700,000 Rand Porsche than it is for a 700,000 Rand 3 Series. So at the moment, I have an E63 AMG, which is 370 kilowatts plus, and I paid 220 grand for it, which is polo money for a car that will smoke practically anything if I really wanted to. They are insanely powerful cars. I overpaid a little bit for this one because it's the only dark green one in South Africa, to my knowledge. So again, the car geekiness, I have to taper it down a lot on the finance ghost, but I am a complete petrol head, as you said. But again, you know what? If that loses 30 or 40 grand in value over a couple of years, I've had an absolute blast with it. To be honest, the petrol is what's killing me, not the depreciation. And people are terrified of maintenance. And this is another point I need to make. They look at this and go, this is a disaster. It doesn't have a maintenance plan. What will I do? Well, newsflash, if you don't have the sort of slush fund available for maintenance, then you have no business trying to buy an 800,000 Rand car with a maintenance plan. Just get out, walk away from that BMW dealership, walk down the road, go back to Auto Trader and change your filters because you need the slush fund first. So on that Merc, for example, yes, something can go badly wrong. Every time one corner of the suspension needs to be replaced, it's a 25,000 Rand exercise. One of those has happened in my ownership of the car. Maybe one more will happen worst case, but I've probably already had to deal with that. Yes, that's 25 grand and it's annoying. Go work out what happens in the depreciation of your new car when it runs out of motor plan. So Mrs. Ghost has a BMW. She's got an X1. It's a few years old now, and had to sort of extend the motor plan for a year because the problem is on those cars, if something goes wrong, you pretty much need the dealer to fix it, and it can be very expensive. Extending the motor plan, I forget exactly how much it was, but I think it was around 25 grand, give or take. And that's now our annual maintenance on that car locked in. Now, it's very easy to say, oh, the maintenance plan was finished. Just trade it in. Trade it in on a new X1, or maybe it's time to get that X3 with a residual. And again, go and work it out. Even if we had a terrible maintenance experience this year on both cars, it would still be less than the interest I would pay on an 850,000 Rand 3 Series. My Merc would have to break horrifically over and over and over again to come out in the same position as the interest on a more expensive car. And maintenance is a risk. It's a probability game. Something will break, but you don't know what, and you don't know what the probability is. Interest is a guarantee. If you owe the bank 800,000 Rand and you are paying 10% a year on that, 80,000 Rand this year is gone in finance costs. That's a pretty big maintenance bill. Things have to go badly wrong for you to be 80 grand out of pocket. But people are scared because they don't have the 80 grand available. They want to spread it through a monthly payment rather than go through the work of saving it up, having it available, and then being able to drive these cars.
So I think I can't agree more. And I think one of the things that you're saying there, it's kind of implicit, is when you're driving an older car, you're not obliged, unless it's really kind of a difficult car to maintain. You're not obliged to take it to the dealership to be maintained. And certainly that's been my experience. My wife's car is 11 years old, and we've got a great, garage down the road that we take the car to. Fantastic mechanic, and the car is extremely well serviced. We make sure we stick to kind of the service routine because I sure as heck don't want my wife driving an unsafe car. But the point is, our service bill, I don't think would cover kind of a tenth of what the service cost would have been if we took it to a dealership. And I think that's key. It's find a good, reliable mechanic as well, and then be disciplined on sticking to the service intervals. Whether it's, if you don't drive a lot, at least once a year service the car. If you do drive a lot, make sure that you're doing it according to what they want you to do. And then my eyes were getting bigger when you started talking about the Porsche, because I would think that parts and stuff for something like a Porsche would be pricey, whereas couple of year old or 5 or 10 year old Merc or BM, unless it's extremely rare like the cars you're buying, the parts are not going to be that expensive, and I think that's the important point as well.
So Warren, so on average, yes, on some of the older cars. So for example, sorry, I can geek out about this all day, but if you drive a Maserati from that period, you will get murdered on parts. You will. That's a fact. Aston Martins are terrible. Porsches are really not bad. I can tell you now, to maintain one of those 911s is absolutely no worse than maintaining any BMW from that period. Not necessarily a fast BMW, any BMW. I have a friend with a Ferrari 458. His annual service was only 2,000 Rand more than what BMW charged on the X1 for a Ferrari 458. Now, obviously, when you're replacing carbon brakes, that's a complete, that's LSM 500 only need apply. Clearly, we're not saying that. But on something like an older 911, it's really not that bad, and especially when you take into account total cost of ownership. Yes, if you've only got 10 grand spare in your bank account, please don't buy a Porsche. But, on an average basis, it's not such a big difference. And the thing I've learned, because I've owned, 15, 20 cars, definitely more than one a year on average, because that's then I change them often. So that's the other trick, by the way. Don't own them over a major service. Do your research around. So, for example, on the Honda, at one point, there's a really big service you need to do on the diff. It is hellishly expensive. I think it's at 100,000 kilometers, if I recall correctly. Hopefully, I'm not getting this wrong. So I made sure I sold mine before that service happens, because you never get your money back on that stuff. You do the big service, you do not get that money back. So on the Porsches, for example, there's preventative maintenance you can do on certain bearings. You don't really get that back in the purchase price. But if you bought one that hasn't had it done, you're going to probably spend that, and then that money's gone. So it's a little bit like stock picking versus buying the index fund. Actually, you have to really know what you're doing. Do your research. It's not a passive purchase. I think if you're buying one of these cars, you've got to be willing to do the hard yards. But if you get it right, for the price of a new GTI, you'll be driving a 911, and it'll cost you less than the Golf.
Okay, I think on that note, you slipped in a bit of stock picking, and I think it's a nice segue into the last part of what I want to talk about today, which is about buying shares and maybe just a bit more specifically around shares in South Africa versus shares overseas. And I'm going to just remind our listeners, if this is of interest to you, have a listen to Magic Markets Premium. I think it's you get a lot of information in a lot more detail around specific companies than we would cover on Honest Money. I think we tend to zoom out a bit, which is my happy place. But I thought Finance Coast, that's a kind of to open the door to you to talk about this.
Yeah, thanks, Warren. So we focus in Magic Markets Premium on the US market, although we have covered a couple of European stocks, but mainly the US market. And the reason for that is the US market has the biggest brands in the world. I mean, any of the products that you own that are big international brands, there is a very high probability that company is listed in the US. If you use Nike shoes, you'll find it there. If you drive a Ford, you'll find it there. The list is almost endless. So the US market is incredibly interesting, and it's also very exciting because the companies report every quarter as opposed to every 6 months. So the information is always a lot fresher. Something I personally like is there's no nonsense in the US. This world of like big integrated reporting, et cetera, definitely has a place. But for me personally, I'm interested in how the business is performing. And the whole US market is very geared towards telling you how the business is actually performing. The other thing that's really cool is you can always get the transcript from the analyst call. You can't do that in South Africa. If you're lucky, and if you really want to, you can go watch the whole video presentation, and maybe there'll be a couple of questions at the end. But in the US, it's strict. These guys, generally speaking, for a lot of the analysts, that's the only access they get to management. It's all recorded. So you can see exactly the same questions being asked by this highly trained, highly skilled analyst from Goldman Sachs, and you can see the answer. So to upskill yourself on how to really understand a company, the US market is honestly just incredible. But you have to be careful. You can't always assume that investing in the US is better than investing in South Africa, because that's just not the case. If you get it right in the US and you buy certain blue chips, you'll typically get a compound annual growth rate in the share price of somewhere between 8 and 10%. You're doing pretty well. Dividend yield is maybe 1%, maybe 2%, depending. So you're looking at making sort of 10 to 12% in dollars over time. Now, that's actually a very good return. US treasuries are currently sitting at 3.7%. So you're making an equity risk premium of over 7, which is excellent. The equivalent of that on the JSE, because of where the South African bonds are, is 17 or 18% total return. Good luck achieving that over a basket of stocks. So because the US is such a potent economy and their companies service the whole world, they can do very, very well. But the problem is, as a South African, you're not earning dollars. You need to take your beautiful randellas and change them into dollars. And sometimes our randellas are not so beautiful. And the problem is, like right now, for example, if you haven't already got a US portfolio where you can either change some positions around, or if you're sitting in US dollars cash that you can deploy, if you're only sitting in rands right now and you take money out at the current levels over 18 rand to the dollar, the problem is if you look at those stocks in rand terms, even though they've come off pretty hard in their dollar-based valuation, they're expensive in rand. So you can have a scenario where you take the money out, you go and you buy stocks, and then sort of the risk of sentiment starts to wane. Equities rally on that side, sure, but the rand also strengthens. So by the time you actually want to bring those dollars back, you're buying far fewer rands than than the exchange rate when you took the money out. So the biggest advice around this, hashtag not financial advice, is separate the currency decision from the asset decision. So don't be scared to hold dollars cash. If the rand is strong, you can take money, park it in dollars. If you use easy equities, for example, you can do that, and wait to buy the shares. You don't always have to do it all in one where you move into dollars and then you buy shares immediately. You don't have to do that. You can get into dollars, wait for the valuations in dollars to be more favorable, and then invest actively on that side. And that's something that I think a lot of people get wrong and they get hurt in the process.
Yeah, and I think it is a great point that I'm absolutely kind of manically worried about market timing as a philosophy. I think it's an impossible thing to do, and I know intuitively it's such a nice concept and it's so easy in hindsight, but in reality, I would say an impossibility. And so when I've got lump sums of money to invest in the stock market, and it doesn't matter how I do that, whether it is shares, ETFs, unit trust, doesn't matter. I tend to feed my money in over time. I tend to batch it in, making sure we kind of spreading out the transaction costs as well, because that you've got to watch your transaction costs. But I think feeding money into an investment like the stock market makes a lot of sense to get rid of that risk of something just blowing up just 3 days after you've put your massive lump sum in and it falls apart. That's a reality that you need to be aware of. And I think also I saw some numbers yesterday from one of the people in our industry showing investing in the UK from rands going into pounds 7 years ago, and investing in the UK market versus investing in the JSE. Someone who invested in the UK market 7 years ago is probably twice as badly off as someone who invested in the JSE 7 years ago. To kind of bet on the JSE only going one way, which is down, or the rand only ever destroying your wealth is simply not true. And I think we've got to have context to everything. The US market, as you say, it is a brilliant market as a whole, but looking at the rand and the dollar and saying, well, the rand's at 18 to the dollar, it's only going to go to 20 or 30. It might do that over a 2 or 3 decade period. But from 18, it could comfortably go back to 1650 at a point in time. And it won't have a lot to do with load shedding and who the president is, what we've done with the ESCOM board. It will have to do with what's going on in the world and how the world feels about emerging markets and about taking risk or not taking risk.
100%. The value of the rand right now is being driven by the Fed. Yes, we don't do ourselves too many favors, but that is not why the rand has gone to where it's gone. So, my view on these things is nothing is ever as good or as bad as it seems. And if you really believe South Africa can only ever get worse and international, jurisdictions can only ever get better, then I would recommend you put your trading app down and you read the news, because you will find that is just clearly not true. Currently, we're in a country where, yes, obviously we have a huge issue with ESCOM. Like, no one's denying that. We also have incredible commodities, which have seen us through over the past couple of years. We should, in theory, now have an amazing tourism season. I suspect that the American accent is going to be common at the waterfront in December this year, because they can come here with their dollars and buy an entire McDonald's franchise for the same price as a Big Mac back home. And that's great. Fantastic. Welcome. Thank you. Go to the Kruger, go to Cape Town, spend your money here, bring us your dollars. We want them. South Africa still has every chance of doing well. I think, just to temper that though, one thing I like on the JSE, Warren, I know this is not, necessarily where you play, but you can do a lot of really cool sort of swing trading and shorter term positions because you're familiar with the companies. You're going to the shops yourself. You can see that this retailer is doing better than that retailer on the ground long before the results come out. And you can play those sort of relative positions, etc. If you're a stock picker, again, this is not index stuff at all. Whereas internationally, we're not on the ground. and also the ground is the whole world. You can't possibly guess how Nike is doing based on how your local store is doing. You just can't. So there it's a much more sort of high level, yes, I like this company long term. This is an okay entry point. Let me add Nike to my portfolio or not, as the case may be. Whereas locally, I think it's more a case of, okay, everyone hated Woolworths until the end of last year, but actually the new CEO is doing some good stuff. I can see it in the store. Maybe that's not a bad punt this year. Woolworths has way outperformed ShopRite year to date, on the share price at least. Those sort of things you can only really do in a market where you understand it.
Yeah, and you take the time to kind of go with your eyes open, do your research, be awake and aware of what's going on, and then do the homework. Don't rely on social media to tell you what to buy and what to sell. Do your homework and take responsibility for your money.
100%.
Finance Ghost, we've blown through our time about 10 minutes ago because this was such a fantastic episode. I was really enjoying it, and I just want to say thank you so much for joining. I've learned a lot. I'm probably still not going to go and buy the old Porsche, to be honest, because my wife will shoot me firstly. But secondly, I need to kind of kick the car habit for a while and keep building up my investments. But I appreciate your time, and thank you so much for joining us.
Thank you. It's always fun, Warren. I appreciate it.
Brought to you by Prescient Investment Management. Informed by science. Guided by insight. Prescient Investment Management is an authorized FSP.